2. Read the WACC formula before you build it. 1 rate, 2 providers. Every company raises capital from 2 groups: shareholders who provide equity and creditors who provide debt. Each group expects a return for the capital they commit. Shareholders expect dividends and stock price appreciation, while creditors expect regular interest payments. WACC, or weighted average cost of capital, combines both return requirements into 1 rate, weighted by how much of each capital type the company uses. KE is the cost of equity, meaning the return shareholders require. KD is the pre-tax cost of debt. Multiplying KD by 1 minus the tax rate converts it to an after-tax cost, because interest payments are tax-deductible in most countries. E is the market value of equity, and D is the market value of debt. The equity weight is E divided by total capital, and the debt weight is D divided by total capital. Together, both weights always sum to 1, where WACC gets applied. WACC functions as the discount rate in a discounted cash flow model, converting each year's projected free cash flows into a present company value. Companies also apply WACC as a hurdle rate when deciding whether to approve a new investment project or assess business feasibility. If a project's expected return exceeds WACC, the investment creates value for shareholders. If expected returns fall below WACC, the investment destroys value. This logic holds whether you are valuing an entire business or evaluating a single capital expenditure. Part 2. Why WACC has real limits. Applying WACC accurately is more involved than the formula suggests. One challenge arises when a company operates across multiple business units with different risk profiles. Consider a company with one division producing semiconductor chips and another providing financial services. Both divisions sit inside the same company, but they carry very different levels of risk and growth potential. In theory, each division should carry its own WACC, and the company-level rate should be a weighted average across all divisions. Applying one blended WACC to the entire company can overvalue the riskier divisions and undervalue the more stable ones. A second challenge involves how risk changes over time. A company growing rapidly today may mature significantly over a 10-year forecast period. Applying one fixed WACC to every year of that projection does not fully capture how the company's risk profile evolves. Handling these complexities requires more advanced techniques that go beyond the standard model. Ask AI first. Before calculating each WACC input yourself, use AI to generate a complete estimate for NVIDIA. Try this prompt. Calculate WACC for NVIDIA using its most recent fiscal year data. Use market value weights for equity and debt, the current 10-year U.S. Treasury yield as the risk-free rate, Damodaran's implied equity risk premium, and NVIDIA's adjusted beta. Show every input and the final WACC calculation step by step. As you build each component yourself, compare your result to what AI produced.